Hey, Christina Haganey, President of Valor Payroll Solutions. Thanks for joining us as we do a Payroll 101 walkthrough. So this is for all the small business owners who have employees or may be getting ready to hire their first employee, just to give you a general knowledge base for what happens with payroll. So employee versus contractor is a really popular topic because it's becoming more popular as something to go after employers for. So there is new legislation on the table right now, kind of changing how we classify employee versus contractor. But I think it's really important for business owners to understand truly what the difference is. So if you're working with a true independent contractor, they are hired usually for a temporary project like a job. So they're not hired indefinitely, but to perform a certain thing or have a certain result, and then they're done. Contractors also are able to choose when and where work is performed and really how they want to do the job. They usually bring their own tools and they're usually paid a flat fee or hourly rate, and then they invoice the company because, again, independent contractors are in business for themselves. So they will usually invoice you and get paid on their terms. They may decide net 15 or net 30, which is very different from an employee who's going to be on a set pay frequency that's determined by you. And then independent contractors do have the potential to incur a loss. They don't get reimbursed for expenses. If something goes wrong on the job, they may not get paid. So again, maybe think of a plumber that comes to your house. They're coming, they're going to go fix your sink. They decide how much it's going to cost. They bring their tools, they come in, they do what they do. And then when the result is accomplished, they invoice you and tell you how much you owe them. On the other hand, employees really are highly controlled by the employer over when, where, and how the work is performed. So that may mean things like they are provided tools to perform the job, maybe a computer or even a company email address. They're told how to do the job and usually given some type of training. And then they can be eligible for company sponsored benefits. So that could be medical, dental, vision, retirement, paid time off. It doesn't mean you have to give those things for the worker to be an employee. However, contractors will not usually receive those types of benefits, whereas employees can sometimes. And then employees are subject to FLSA rules, so they're able to earn overtime if they work beyond a certain amount of hours in the week, which is usually 40. So very different setup and relationship when it comes to those two kinds of workers. And then according to the IRS, the general rule is that an independent contractor, or the general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how it will be done. You are not an independent contractor if you perform services that can be controlled by an employer, what will be done and how it will be done. This applies even if you're given freedom of action. What matters is that the employer has the legal right to control the details of how the services are performed. So to me, that's a very clear distinction. If someone's coming in and they're ready to do the job and get the end result that they've been hired to do, they're a contractor. If not, if the person is showing up, being trained, given job supplies, you're telling them what to do, what time to be at work, things like that, employee. And then I think it's really important to note the risk of misclassifying employees because, of course, if there's no risk, there's no push to do it correctly, but there are some risks. So when you misclassify a worker as an independent contractor, you are not collecting taxes from them. You're also not paying the employer portion of FICA taxes, which are Social Security and Medicare. So at the end of the day, if you get caught misclassifying workers, you could owe up to 40% of the FICA tax that you should have withheld from the worker. You'll also have potential for penalties and interest for not filing or late filing for state unemployment and withholding tax returns. If those wages are being classified as contractor wages, they're not going through payroll, so you're not withholding taxes, remitting those amounts to state agencies. They're kind of off the grid as far as payroll is concerned. So once you realize you've misclassified, really you're supposed to go back and fix everything and change the wages around and report them as W-2 wages, which is where the penalties and interest can come in. The independent contractors are usually not covered by your workers' comp. So if they do get injured or have an on-the-job accident or illness, then they're going to want you to pay for that since they are on the job. Independent contractors will usually have their own insurance so that if something happens to them on the job, they're covered. But if you hire someone who's not truly an independent contractor, they're not going to be carrying general liability and workers' comp insurance. So if something happens to them, they're going to want you to take care of it, and it's going to be a workers' comp nightmare. You're going to have penalties for failing to furnish a W-2. Obviously, if you have them as a contractor, you're giving them a 1099. But if you do have to go back and reclassify, you're going to get in trouble for not getting that W-2 to them in the first place. And then you may have wage and hour issues because independent contractors are not subject to minimum wage and overtime laws, whereas normal W-2 workers are. So if you are paying them as an independent contractor and not abiding by federal and state laws, then you could have some issues there as well. And then lastly, if the worker does terminate, or if the worker is terminated and they go and they try to file for unemployment benefits, the state agency isn't going to have those wages because you were paying them as a contractor, but they are going to reach out to you and say, hey, Jane says she worked for you for 6 months and paid X amount of dollars, but we don't have those wages. Can you tell us why? So once you've determined if your worker is an independent contractor or an employee, if they're an employee, the next step is to determine if they are exempt or non-exempt. So non-exempt employees are not exempt from FLSA laws, which are the laws that govern minimum wage and overtime. An exempt employee has to be paid a salary of at least $684 per week, and their duties must meet the duties per FLSA. And you can look at FLSA's fact sheet 17 to see details about those specific duties that could potentially make an employee exempt. So when you have an exempt employee, it is okay to not put them on salary and choose to instead pay them hourly. And you can pay them overtime as well. No issues there. But if you have an employee that's not exempt, then you do have to pay them overtime as required. At a federal level, that's 1.5 times the regular rate of pay for all hours worked over 40 in a work week. But keep in mind that if your state has different rules for minimum wage or overtime, such as California, then you do have to do whatever is most beneficial for the employee. Once you're ready to onboard an employee, you're going to want to make sure that you have the proper forms and give them to them at the required times. So it's best practice to have an employment application, but there's no requirement that you have that. If you're going to be doing direct deposit, you definitely want to include a direct deposit authorization in your new hire packet, which will let the employee sign to deposit their funds into the bank account that they provide. Each employee should complete a federal W-4, which is going to tell you how to set them up in the payroll system for federal income tax withholding. If you're in a state that has state income tax, there may also be a separate state withholding form, which will help you to set up your employee for state withholding. Some states that have income tax do use the federal W-4 form, but you can check out our website to see if the state has a state form or uses the W-4 and just grab it there. The I-9 is super important and is required for all new hires. However, the I-9 should only be provided to the employee after they've accepted a job offer, and it should be completed by the employee no later than their first day of work. Then you as the employer will need to examine those documents that the employee provides and make sure that you complete your section within three business days from the employee's date of hire. That is a very important form and it should be kept separately. And you really need to make sure that you're not only filling those out, but filling them out on time and filling them out accurately. And then each state has its own requirements for new hire reporting. Most states are going to require that you report that new hire within 20 days of the date of hire. And there are usually multiple options for how to report the new hire. So some will accept the W-4 faxed in. You can also go to an online portal to report those new hires. Our business, Valor Payroll Solutions, does that on behalf of clients. So if you are working with a payroll provider, you may check with them to see if they handle the new hire reporting for you. And then there may be some state-specific documents. California is going to come up in a lot of examples because they are a very stringent state. But using California as an example, there are some state-specific documents that should be provided to the new hire. So you want to double check if there's anything specific required in your state. Another thing that most business owners don't realize is that each state actually dictates how often you should be paying employees. And sometimes that frequency can vary depending on if the employee is exempt or non-exempt. But you definitely want to make sure before deciding on a pay frequency that you're going to be in compliance with the state rules where you have workers. And then lastly, states have different requirements for what goes on a pay slip or a pay stub. Now, if you're using a payroll software, most likely you will be fine, but it doesn't hurt to double check what those requirements are to ensure that you are in compliance. Now we're going to jump straight from hiring to terminations, because terminations are another important thing that you should be aware of before you do your first one. So each state has different requirements on when final checks are due, and it usually depends on if the termination was voluntary or involuntary. So voluntary termination would be if the employee resigned, whereas an involuntary termination would be if you terminated the employee or fired them. If the employee has an active garnishment, you will want to make sure that you report that termination to the garnishing agency so that they do not expect to continue receiving payments from them. And then another thing that's not on this slide, but it's very important, is if you do offer paid time off, different states have different rules as to whether or not those hours must be paid to employees. And one last point here that's not on the slide, but it is actually illegal to withhold an employee's check if they haven't returned equipment. You're still subject to those final check laws, so don't do that. And now we're getting into the meat of payroll here. So if you've been following along so far, don't give up on me now. Payroll tax types, super important and definitely something that you want to have a basic understanding of. So in payroll, you are going to have federal withholding, which is the amount that you withhold from the employee's check for their federal income tax. If the state has a state income tax, you will also have state withholding, and that is also something that is going to be withheld from the employee's check. Then you have Social Security tax, which is 12.4% total, but that is split by being paid 6.2% by the employer and 6.2% paid by the employee. Now, each year there is a cap on the amount of wages that are taxable for Social Security tax. And in 2023, that's $160,200. But again, each year that will change. If you use a payroll system, that should be updated for you on the back end to where once you reach that cap, the tax will no longer be calculated, but definitely something to be aware of. And then you have Medicare tax, which is cumulatively 2.9% of subject wages, but again, split 1.45% paid by the employee and 1.45% paid by the employer. Now, unlike Social Security tax, where there's a cap, and then after you exceed that, neither the employee or employer pays any more tax, on the Medicare tax side, if the wages are in excess of $200,000, the employee is actually going to be paying an additional 0.9% on those additional wages, but not the employer. Then there's state unemployment tax, and each state determines their own taxable wage base and also determines their tax rates. So, for example, Texas is 2.7% for new employers, whereas Oklahoma is 1.5% for new employers. And then again, the wage base will vary. I know in Oklahoma it's more than 20,000 this year, whereas Texas I think is 7,000 or 9,000 for the wage base. So the amount of state unemployment tax that you will pay will vary depending on the state's taxable wage base and also your rate as the employer. With state unemployment tax, if you have benefit claims, that will eventually increase your rate. Whereas if you do not have claims where people are requesting unemployment benefits, then your rate should gradually decrease over time. Then we have federal unemployment tax, and this one's a little tricky as well. So it's 0.6% of the first $7,000 paid, which caps at $42 per employee per year. But we are back in a period where we do have FUTA credit reductions. So FUTA is actually 6% with a 5.4% credit, which makes it 0.6%. But certain states that have loans with the federal government will incur a credit reduction, which then increases that FUTA rate. Unfortunately, we don't know that each year until November. So then at that time, we learn which states have a FUTA credit reduction, and you may see an extra debit or charge in your payroll system if you have employees in those states with the credit reduction. But most states do not have that. So for most folks, it's going to be a cap of $42 or 0.6% of the first $7,000 paid. Then we have some local taxes, which depends on the state entirely. So most states don't have local taxes, but then some states have many, many local taxes. The worst of which is Pennsylvania, where they have municipalities and school districts and lots of EIT, LST. So they have a lot of different local taxes. But again, that's going to vary by state, and most states do not have those, but something to keep in mind. And then lastly, we have paid family and medical leave, which is not actually a tax, but we are seeing more and more states enact these paid family and medical leave laws. And so each state that enacts them determines who pays and how much. So in some states that have paid family medical leave, it may be only the employee paying. Sometimes it may be the employer. Sometimes it can be both. Sometimes it's the employee, but the employer is allowed to cover it. So again, just do your research on your specific state or reach out for help. But it's going to vary by state for the bottom components, the local taxes and the paid family medical leave. Once you have calculated the taxes and have that ready to go, you're going to then have to remit those tax payments to the proper tax agencies. So going in the same order here, for federal withholding, there are two deposit frequencies, semi-weekly or monthly. So a semi-weekly depositor is going to be someone that had a $50,000 liability on their 941s in the look-back period, whereas a monthly depositor is going to be a business that had less than a $50,000 liability in that look-back period. For semi-weekly, you run payroll and then the tax is due within a few days. For monthly depositors, the tax is going to be due on the 15th of the month for the prior month. So for example, 941 liabilities in August will be due September 15th. The state withholding is going to depend on the state and also the liabilities. So depending on how much you're withholding from employees will in effect determine your payment frequency for state withholding. Generally speaking, the more that you withhold, the more frequently you will be required to remit those amounts. The next two, Social Security and Medicare, those are going to be lumped in with your federal withholding payments or your 941 payments. So same thing there. You're either going to be doing those semi-weekly or monthly. State unemployment is due the last day of the month following the reporting period. So those are quarterly. And then the payment is due within a month after that. So for example, quarter 3 is going to go till September 30th. So those payments for unemployment tax will be due by October 31st. For federal unemployment, this tax is due quarterly if the liability is $500 or more, but it's due annually if it's less than $500. If you have a quarter where your federal unemployment liability is less than $500, you carry that liability forward to the following quarter. And then if in that quarter your cumulative liability, so the carryover plus your current quarter, exceeds that $500 threshold, then you remit that payment quarterly. It's best practice just to go ahead and remit that quarterly so that you don't have to worry about calculating anything. But if your total liability is under $500 for the year, you do have the option to wait and pay that by January 31st of the following year. And then local taxes are going to vary by state. Usually those are going to be monthly or quarterly, but again, depends on the jurisdiction and possibly the amount you're withholding. And then paid family medical leave, again, can vary by state. Right now, we're seeing most of those are quarterly, but as always, do your research on your specific state and make sure that you're in compliance. So as you get going with payroll, you may end up having to take deductions from your employees' checks. But just like anything else with payroll, we want to be very careful about what we're doing and how we're setting them up. So if you are an employer and you have a Section 125 plan in place, then if you do set up health benefits like medical, dental, vision, those can be deducted pre-tax. The benefit there is that it reduces the taxable income, which ends up in a tax savings for not just the employee, but also the employer. But the key here is that you do have to have that Section 125 plan in place to be able to take those deductions pre-tax. It's also worth mentioning that S Corp owners cannot participate in Section 125 plans, meaning S Corp owners cannot have pre-tax benefits on their check. Some deductions can be either pre or post-tax, like long-term and short-term disability, and that is going to be dependent on who's paying those premiums. And then there are certain AFLAC or supplemental benefits that can be pre-tax or also post-tax. Any deductions that you're taking from the employee's check should be authorized prior to taking them. That can be electronic signature or a actual paper, but regardless, you do want to have the employee sign off that you're going to be withholding those amounts from their check. The exception to that would be if they have a garnishment order or child support order. If you receive an order like that telling you that you have to withhold money from the employee's check, then you do not need the employee's authorization to go ahead and implement that order. Also keep in mind that deductions can have caps or maximums like FSA and retirement contributions. If you're using a payroll software, this is usually built into the software, but if you are doing payroll manually, make sure that you pay attention to those maximums and don't exceed them. And then lastly, if you have an employee who's being terminated for any reason, make sure that you're looking at the rules of the state before you go doubling deductions or taking anything extra. And again, absolutely do not withhold that employee's check in its entirety. That is a big no-no. So when it comes to your employees and processing payroll, with very few exceptions, anything that you pay to the employee is going to be considered taxable income. Some of the things that we get asked often are gift cards taxable? The answer is yes. Anything that you pay or give to that employee that can be calculated and a value added to it has to be entered in payroll. Sometimes you even have to enter things as non-cash just to go ahead and get that amount taxed. So any perks, taxable fringe benefits is what we call them. Make sure those are getting entered into payroll, even if they aren't actually just dollars and wages. For non-taxable reimbursements, those are limited to business expenses, and you are allowed to reimburse the employee non-taxable income for those expenses. But the employee should be providing you with a receipt, and you should only reimburse them the actual amount that they paid. You shouldn't, for example, give them like a stipend of $100 a month for meals and then just leave it at that. You need to get those receipts and then true up if necessary if you're paying in advance of them spending the money so that they're not earning anything. They're only getting a net zero being reimbursed for what they paid. Another thing to keep in mind is that you should not be giving the employee extra income for things like a health stipend. You can set up an HRA where employees can submit qualified expenses and get reimbursed on a non-tax basis for those, but that is through an HRA plan. And if you don't have a health insurance plan and you want to give employees extra money because of that, you can, but it should just be an increase to salary. It should not be tied to them actually getting benefits, and it should not be broken out as a separate line item like health stipend. And then lastly, kind of touched on this, but any fringe benefits that you're giving to the employee, like if you're paying for a gym membership, if you're paying for them to get house cleaning, anything that you're providing to them that has a monetary value, that needs to get processed through payroll and does need to be taxed. So just to summarize here, when you are getting ready to hire a worker, the first thing you need to do is make sure you're properly classifying them as either an employee or an independent contractor. For your W-2 employees, you're then going to need to determine if they are exempt or non-exempt. When you hire them, you need to make sure that you're giving them all of the necessary new hire documents and make sure that you are paying them according to the requirements of the state where the worker is performing work. If you do have to terminate an employee, make sure that you're in compliance with all laws regarding that termination, which is going to include when that final check is due, what deductions you can or cannot take from their final check, and also if you're required to pay out any accrued paid time off upon termination. With payroll, you're going to need to make sure that you properly calculate and withhold the proper taxes from your employees' checks, and that you remit both the employee and employer taxes as required by each tax agency. Deductions can be pre-tax or post-tax, so make sure you know what you're doing when you're setting those deductions up. And then anything that you pay to an employee is considered income, even if it's not wages through payroll. So make sure that you are including any of those taxable fringe benefits and processing those through payroll.